Are bonds and stocks sending very different messages about the state of the economy? It's a good question. Let's get some answers. Matt Miller and Dennis Davitt are your Trading Nation team today. I'm Brian Sullivan, as always. Matt, we'll start with you. Do you think they're saying something different, bonds and stocks?
Well, there's a question of what is the bond market telling us? Is it telling us that they're concerned that the economy isn't growing as fast as some people are looking at, whether it be the U.S. economy, which we've seen some real nice numbers there, and the global economy, where we've seen equally good numbers around the world, especially in Europe recently. But we also have a situation where the positions are very, very extreme in the bond market. We have people that are set up on the short side of the bond market. So in other words, they expect the bond prices to go down and bond yields to go up. And in fact, they're even bigger positions than they were at the beginning of the year when you couldn't get, didn't think you could get any more extreme. And sure enough, the bond market rallied and yields came down. So I think at least over the intermediate term, when I say intermediate, next few weeks, maybe a couple of months, it's going to be hard for interest rates to really move significantly higher because everybody is on one side of the boat. So to answer your question, is that just because the economy is getting better, it doesn't necessarily mean that we'll have an immediate increase in interest rates. And so I'm not exactly sure that it's going to be telling a different story than the stock market is telling us, but it's certainly something to keep an eye on.
Dennis, what do you think? Stocks and bonds, different story or just maybe same story, different way?
Well, having spent my life as an equity guy, I'm always going to say the bond guys don't know what they're talking about.
They'll say the same about the stock guys, by the way.
Exactly, as it should be. My view on this is that I agree with Matt. One of the things you have to be very aware of in this market is the structure of the market. So how one-sided position people are. The worst unwinds in the world are unwinds of carry trades. As people move into these carry trades and they unwind, it sends things spinning in directions that we never thought they would go in. What's going to make that unwind happen? If I had to pull a tail event out of it, it would be the end of QE in Europe. If the European economic numbers are as strong as they are, and suddenly you see the Europeans pull back on QE and actually start look to moving towards a rising rate environment, what does that do to the dollar trade? What does that do to the rate trade? I also think we have a generation of bond traders that have never seen a bear market in bonds. Since 1994, we've been in this strong dollar, lowering rate sort of environment overall. So what the bond guys are telling us is going on as far as rates are concerned is a concern of mine. They're very good on credit because credit ebbs and flows. But as far as rates are concerned, without having seen a bear market in rates, is this the trigger point? Will it go the other way, or is this just a hiccup, and all of a sudden an unwind comes in through an unforeseen circumstance?
Good stuff there. Looking at stocks and bonds. Dennis, the stock guy, will always tell you stock guys are the smart ones. Matt will probably agree because he's a stock guy too. Thank you both very much. We appreciate it, folks. Check out the live version of Trading Nation on CNBC's Power Lunch. I'll see you there as well. Have a great day.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.